What's the best strategy to ensure a healthy retirement income for many years? How much money do you need for your retirement? Often financial advisors suggest limiting retirement spending to 4% of your total portfolio, but in times of a looming recession, that number might even be too high. If and when there is another major recession, will advisors suggest withdrawing less than 3%? Retirees withdrawing 4% of their portfolio every year might end up seeing their holding balances decrease, especially if they live longer than expected. This can leave them wondering how much longer they'll need to draw from those accounts if they want to live comfortably for as long as possible. In our final years, the last thing we want to worry about is having enough money to sustain our existence. Most people would prefer not to be hobbling to a job, or worse, not being able to work at all, depending on physical and mental condition. Thankfully, there are retirement investing strategies that don't require spending the principal of your investments. Rather than being forced to sell off your stocks to fund retirement, wouldn't it be better to hold on to them as they gain value? Instead, it's possible to live on the cash flow investments provide in the form of dividends. By investing in stocks and funds that pay dividends, you can keep more of the portfolio intact because the money paid out doesn't decrease your equity. Think of the dividend payments like cash flow from rental property. Extra income is paid out to owners while the asset still has the potential to increase in value. Most retirement strategies require the owner to sell the asset so they'll have the money for their everyday expenses. This is like selling off your rental properties when in need of money, instead of living off the cash flow left over after expenses are paid. Why kill the goose when it continues to lay golden eggs? That strategy isn't always sensible if it's possible to live off cash flow instead. Getting this type of investment started as soon as possible is ideal, so you'll earn more each year towards retirement. If you enjoy videos about money, personal finance, and investing, all topics that will help you better your financial future, consider subscribing to the channel to see more videos. If the video is helpful, make sure to hit the like button. When you buy a stock, you become an owner of the company. As the company grows and makes a profit, that growth is passed on to shareholders in two different ways. Most common is the capital appreciation of the stock's value when the company reinvests profits into the business. For example, if the stock was purchased for $50 and the price increases to $100, that's appreciation. While it's not a direct cash flow, your investment increases in value. In order to realize that gain or cash out and take the profit, the stock must be sold. Another way the company can reward its shareholders is in the form of dividends, which is simply the company paying out a portion of its earnings to its investors. Dividends are payments to stock owners, usually paid out quarterly in fixed dollar amounts. Common dividend yields, or percentage of the stock price paid annually in dividends, is around 2%, which is the approximate average dividend yield of the S&P 500. The best thing about living off dividend payments is that theoretically you'll never run out of money, in the same way that if you own a cash-flowing rental property, you'll always receive that cash flow. As the companies in the portfolio continue to grow, develop, and earn money, a percentage of that income is paid out to the shareholders with zero time or effort involved. A healthy company will pay a portion of its income to the shareholders while reinvesting a portion into the company to ensure it continues growing in the future. Dividends come in as income, and the business continues to increase in value, building more equity for the shareholder. Another advantage of living solely off dividends in retirement is the opportunity for increasing income every year. For example, if a company pays out 4% of its share price on average, as the share price rises over the years, a solid dividend-paying company is likely going to raise their dividend to maintain it at 4%. In other words, the stock price might be $100 with a dividend of $4. Over time, as the stock price rises up to $200, the company will likely increase its dividend payment to $8, maintaining the 4% yield. Not every stock is going to have an increasing dividend, But this example isn't something unreasonable to expect from a healthy business. The same can be observed from a fund of stocks. The S&P 500 has an average dividend yield of approximately 2%. As the market rises over the long term, the dividend payments generally rise with it, leaving retirees with a pretty stable paycheck without having to sell off their investments to fund their lifestyle. Coca-Cola has been increasing their dividend every year since 1962, averaging around a 5% increase every year, which is higher growth than the average rate of inflation of about 3%. As with any investing strategies, the choices available are seemingly limitless. The easiest and most hands-off approach would be to park the money in index funds or exchange-traded funds, which are a basket of stocks packaged up and provided to investors at a very low annual cost. Reasonable expense ratios for these funds are around 0.3%. There are many different funds available ranging from S&P 500 funds, Dow Jones Industrial Average funds, total stock market funds, high dividend funds, which are selections of companies that pay higher than average dividends, or a fund that holds only the dividend aristocrats. Investors looking to retire on dividends might want to choose a high dividend fund, which could yield about double the amount of the broad market index. The downside to a high yield fund is that future growth is more limited, due to the fact that dividend payers are often large, older companies. Individual stocks are another great place to collect dividends, provided you have the time and knowledge necessary to select a solid investment with future growth prospects to ensure it's profitable for years to come, and the dividend payment doesn't get slashed. However, there are companies that pay 5% or more in dividends. Generally, the higher the dividend, the more risk involved, due to the fact that the company might not actually be able to afford continuing its payments, with some companies in turmoil taking on debt just to fund the dividend payments. This isn't always the case, but something to consider when selecting stocks for purchase. Pay attention to the payout ratio, which is the percentage of net income, or income after expenses, that the company pays out as dividends to common shareholders. A payout ratio of 50% or less is considered safe. When payout ratios climb over 50%, further due diligence should be exercised. The companies that sport higher yields are usually older and more established, like KRAFT, HEINZ, CHEVRON, and VERIZON. New startup companies and those growing at a fast rate, such as Amazon, Tesla, Netflix, and other growth stocks, likely don't pay a dividend at all, and if they do, they're generally pretty small. The reason for this is that management chose to direct a portion of its cash flow to shareholders, due to the fact that they might not be able to efficiently reinvest all of the cash back into the business. Consumer discretionary, consumer staples, energy, financials, and healthcare are examples of sectors that typically pay high dividends. You might analyze the list of dividend aristocrats, which is a list of stocks that has likely increased its dividend consistently for at least 25 years. Examples of these aristocrats include 3M, Johnson & Johnson, Walmart, and McDonald's. Real estate investment trusts are popular for investors who favor high yields over capital appreciation. Due to the structure of a real estate investment trust, or REIT, they're required to distribute most of their income in the form of dividends, making them great for income. Keep in mind that since the dividends are very high, the capital appreciation is minimal. REITs are individual stocks and must be treated as such when considering them as investments. The fundamentals must be analyzed to determine if the business is likely to be profitable in the long term. How much money you'll need in order to generate enough income from dividends depends on the average yield of your portfolio. Say the annual income needed is $100,000. Considering the average yield of the S&P 500 fund of approximately 2%, the amount of money invested in order to generate $100,000 annually in just dividends would be $5 million, or 50 times the income needed. That's a pretty large sum, but remember the number needed depends on the yield you're able to achieve. For example, investing in a high dividend fund instead of an S&P 500 fund would yield closer to 4%. A higher yield of 4% would mean you would only need about $2.5 million, or 25 times the income needed to earn $100,000 per year. The tax structure of dividends is different, which is why it's important to use a retirement account that will reduce your tax obligation. IRAs are best for retirement investing. Dividends might be taxed differently than a capital gains if not purchased within a retirement account. If a stock is purchased at $20 and sold for $100, the gain of $80 will be taxed as capital gains, but dividends received in a given year could be taxed differently. If investing with a brokerage account, taxes will be different than with a retirement account, so it's best to consult with a tax professional to assess your own situation and do what's best for your future. Dividends are a fantastic income source for retirees who have sufficient funding. Dividend payments are very sustainable because there's no need to sell your investments to take some pay. After all, would you want to sell a rental property to fund your everyday expenses? Investing in the stock market is no different. Of course, there's no guarantee with any investment. Even with a cash-flowing rental property, the rental income could decrease, while taxes, insurance, and HOA fees could rise until there's no money left over. This is why it pays to be on the conservative side for retirement planning, especially in your later years. If you build a retirement income plan based solely on receiving dividends, make sure you know that income and principal value can and will fluctuate. However, dividend payments tend to remain relatively stable through rough markets.